A live stream from Smart Money Mamas. This was unplanned as of this morning, and we decided that we had to come in and talk about what the heck is happening with GameStop. Now, typically, I am not someone who comes and talks about random market volatility and headlines because I want everyone in the Smart Money Mamas audience to be long-term investors, buy and hold investors, index fund investors. That's what I want for you guys. It's the least amount of risk, it's the least amount of fees, and that's kind of the best case scenario, right? But when we see situations like this, we see things like GameStop where the market is just out of control and we start to get questions and over the same questions. I know we have to come in and address it. Hey, Janice, so glad you're here. Good morning, Kelly. And so last night we were doing a Q&A in the Motivated Mama Society, and we had a couple questions that were related to this piece of headline. One of which was, should I join Robinhood? Another one, it was, my kid, my 16-year-old wants to buy GameStop and thinks he can make a lot of money. Is this actually what's happening in the world? And in these cases where we have people trying to decide what to do and should they invest or should they not invest when we're following headlines, we got to talk about it. We got to talk about what we can learn from this instance. So if and when things like this happen in the future, we can totally handle it. So as you come in, say hi, let me know if you're here. Let me know if you have any idea what's going on with GameStop or you just popped in here because you saw my crazy chart about how much GameStop is up this week and you wanted to hear what's going on. Let me know your investing experience. Anything you want to share with me would be great. I want to know who we're talking about and what level we're talking about. Janice said, just changing my plans. Curious, and you're the expert. Thank you so much for joining us. This will be so good. So speaking of that, who the heck am I? Okay. If you're not someone who's followed us for a while, maybe you came here just for the GameStop live. Why listen to me on this, right? Why come here and take my insight on what we're doing? So my name's Chelsea Brennan. I'm the founder of Smart Money Mamas. We help moms treat money as self-care and build holistic wealth. So not just money for the sake of money, but also to better your life, to get more of what you want, to live more in alignment with your own values and practice self-care, raise kids who are financially savvy. That's what I do now. But up until 3 years ago, I worked on Wall Street. And so what I did first, when I first got out of college, I was a what's called an equity research analyst. And this is someone who researches different companies, different stocks, and makes recommendations on whether portfolio managers around the world should buy or sell those stocks. And so I did that for a few years. And then I moved to a hedge fund, and you've probably seen in the headlines with this GameStop stuff, a lot of mentions about hedge funds. Now, I was on the debt side versus the equity side. I did high yield and distressed debt, but very similar models of how this works, right? And so I've had experience working with stressed and distressed companies, which companies like GameStop and AMC and Blockbuster are. I've had experience with short selling and all of the things that are happening here. And I want to explain it in a very simple, very easy to follow way. Now, I am excited because I don't often get to go back and talk about the details about investing in a good way. So I've got 2 whiteboards and I've got my money button and I've got some props here. We got our GameStop little prop going on, and we are going to talk about the basics. Okay. So let's just see where people stand in the comments. Kimberly says, I'm from Southern California. I have no idea about GameStop, but I saw it on the news. Let's talk about it. Roberta says, rookie investor, Smart Money Mama team member, was confused about GameStop, but ready to listen. Kelly says, I understand what's going on, but I wanted to hear your take on it as a former hedge fund manager. Okay, cool. Let's talk about what happened for those of you who don't know. Here's our first whiteboard, our first little chart here, all right? 1 year ago today, this is making me very dark. 1 year ago today, GameStop was $4 a share. 1 month ago, $19 a share. 1 week ago, $46 a share. And today, $2.97. Now let's talk about this. From 9 o'clock this morning, when I decided to do this live with you guys, I have had to change this number like 6 times. It was up to 420. It was down to 270. It's very, very volatile right now because of what is going on. And so let's talk about what that is. But first, let's take a think for a minute about GameStop. When was the last time you were in a GameStop? Now, we also know that my audience, you guys are mostly moms. And so if you've gone into a GameStop, it's probably more to buy things for your kids or for your husband, for your partner. But when was the last time you were in a GameStop? Once upon a time, GameStop was the place that you went to buy things like this and to buy video games and to buy new consoles. Over time, they have had to compete more and more with online services, right? People buy on Amazon, people buy games on Steam, people buy consoles from wherever, from online, from on Best Buy. And GameStop has been declining. And what that means is they've had to close stores, they've had to have layoffs, their profits are declining. And in line with that, their stock price has gone down and down and down. Now, they hit a really big hit during COVID when they had to shut even more stores because people weren't coming in and shopping. And so you're talking about a company that was already kind of stressed. They hit COVID, they had to close even more stores, and the price went down. What happened was during this period of time, hedge funds did what called shorting the stock. This is basically, we're going to talk about exactly what that is. But first of all, it's basically betting that the stock price is going to go down and putting yourself in a position where you make money if the stock price goes down. And when you have a lot of people shorting a stock, it can push the value of the stock down. So here comes Reddit. If anyone isn't familiar with Reddit, Reddit is a social media platform and forum that talks about all different wide ranges of things. And they have what's called subreddits, which are different groups that talk about different things. And there's a subreddit called Wall Street Bets. And these are people talking about the stock market trading that they're doing on a regular basis, where they're making money, where they're losing money, what their opinions are. And it's a pretty active subreddit. In general, not one where I would go to get advice, but it is a pretty active subreddit. And about a month ago, people started talking about GameStop being undervalued, getting pushed too low by the short sellers, and that they thought GameStop would recover. It would never go back to its heyday. I don't think anyone was saying like, oh my gosh, everyone's going to go back and start shopping at GameStop and stop shopping at Amazon and Best Buy and Steam and online things. I don't think that's what anybody was saying. What they were saying is the shorts have pushed us a little low. I think post-COVID, this is going to recover. I'm buying GameStop. And some people jumped on board. They started to buy into this. They started to also buy the stock, and that started to push it up and up. That's where we get things up to, $19, $20 from $4 where it was last year. Okay. So it's getting pushed up. What happens is, first of all, this is called talking your book. This is something that anytime you're taking stock market advice online, I want you to be very, very wary of who is giving you that advice and why are they giving you that advice. And in general, if you are a stock market professional and you are talking about a stock, you have to disclose whether or not you have a position in that stock. Do you own it or do you not? And the general, Joes online do not have to tell you that information. They don't have to share whether or not they own a position. And so when we say talking our book, what it means is your book is what you own, your portfolio. And if you own GameStop, you are very interested in going into places where people buy shares and saying like, hey guys, I think GameStop is great. Everybody should buy GameStop. And then the price starts to go up, right? And so you're not supposed to do that, but it's something that happens online. It's just something to be aware of anytime you're taking stock recommendations online. I have no position in GameStop. I don't do a lot of single stock investing at all. Totally index funds here, and we'll talk a little bit more about that later. But that's something that can happen. So GameStop becomes kind of a conversation in the Reddit world. Then people notice that there are more shorts outstanding. And so shorts, we're going to talk about what shorts are, but more people betting that GameStop is going to go down than there are shares of GameStop. And what they know, and we're going to explain how this works, what some of these investors realized was that if they could push the stock price up, even though they didn't think GameStop is worth the $300 a share that it's priced at right now, even if they didn't think it was worth that, they could basically stick it to the man. They could stick it to all these hedge funds that were shorting GameStop and make them lose a lot of money. And it became a game is a poor word for this, but almost a game of let's go screw all the hedge fund, all the Wall Street guys, and make them lose a crap ton of money and maybe make a little bit of money in the process, right? Some retail investors owned the stock at 20 and now it's at 300. And they theoretically, if they sold right now, could make some money, right? And so this became what was happening. People got together and started to rapidly buy GameStop stock. Let's talk about why this hurt the hedge funds. Okay. So you guys are seeing what's happening here. There is a lot of discussion whether or not what was happening on Reddit was market manipulation. It probably was, but it's not well defined by the SEC. Market manipulation is not allowed. It's kind of similar to collusion, where like if a bunch of you get together and try to fix the price of a stock, that is not allowing the stock market to work the way that it should. And so that, how this gets prosecuted, it's probably almost impossible because it's so many small investors. But this is an issue, right? This is something that is problematic because we're trying to manipulate the market. Now, what does shorting the stock look like? We need whiteboard number 2. I'm hitting my thing. All right, guys, let me take this little caption thing off so you can actually see. All right. Everybody tell me if you can see my little chart here about shorting a stock. Drop it in the comments. And if you want to ask any questions, let me know. Tawny says, good morning, investing novice, not concerned about the stock market this week, but always interested in feeling like I can be part of the conversation. Really good to stay informed, Tawny, as you keep going. Okay, so this is my little chart on shorting a stock. Here's Mary. She owns GameStop stock. She thinks, because she owns it, she thinks the price of GameStop stock is going to go up. That is her belief. That's why she owns it. Then we have John here. John thinks GameStop stock is going to go down, okay? He has money, and he thinks that Mary is wrong. So what we're going to say is, what's going to happen is John is going to ask Mary if he can borrow her stock, okay? He's going to say, I'm going to give you some money. I'm going to give you a fee, and I'm going to borrow your stock for a second. And Mary might say yes. Mary's going to say, okay, you can borrow my stock for a little bit to short it. And what Mary wants to know, okay, is that John has the ability to pay her back, because while John thinks the price of GameStop is going to fall, Mary thinks he's wrong. And Mary does not want to end up in a situation where John is wrong and now can't pay her back, right? Because he's gotten out of trouble. So he has to put extra money. He pays her some fee. I didn't get any markers out, guys. I haven't used the whiteboard in a while, okay? Here we go. John pays Mary some money, and he puts some more money into a margin account, okay? This is just a bucket of money that he has to keep to promise Mary that he will be able to pay her back. Now, what does John go and do, okay? We're going to erase here. Give me a quick second while I erase John and Mary, my beautiful art here. Stick figures are a lot of fun. All right, so when John borrows his GameStop stock from Mary, he now has a share of GME. And let's say the price is $20, okay? So John takes Mary's stock and he sells it, all right? And so now he gets $20. So John no longer has the GME stock because he took Mary's stock and then he sold it for cash. So now he has $20. Eventually, he has to give Mary back his stock. And what John hopes happens is that when he owes Mary back that stock in 3 months or 6 months or whatever it is, that the stock is now worth $10. Because what John can then do is he can take the $20 that he got from selling the stock in the first place, buy it back for $10, and he has, I need different colors, $10 of profit, right? So John made $10 because the stock went down. Now, what happens if John is wrong, right? Which is what is happening right now. Let's say he sells it at 20. He's borrowed it from Mary, and now the stock goes to $40. Well, he is now negative $20, and Mary's getting a little nervous. Mary's like, whoa, whoa, whoa. Do you have this extra $20 to pay me back? Where is it going to come from? I want you. And so what Mary wants John to do is one of two things. One, he can put more money into that margin account we talked about earlier, which is promising Mary that he has the money, right? He can prove that he has the money, or he can close his short. And to close his short, John has to go out. He has to rebuy a piece of GameStop at $40 and give Mary back her stock. And when he does, he will lose $20. Now, $20, $10, it doesn't seem like a big deal. But what if you've shorted 500,000 units of that stock? What if you shorted a couple $1 million and now you were wrong by 100% and now you've lost a lot of money? And then take into account, what if you did it and instead of the stock doubling, the stock has now 10x, 20x, which is what we're seeing in GameStop right now. And so what's happened, as the price moves up, more and more shorts get what we call squeezed, right? They are in a position where all of a sudden they owe more money and they have to make a choice between, do I put more money into my margin account or do I close my short? If they close their short, they lose that money. It's done. Just like anything in investing, you don't actually lose money until you close the position, right? So if a stock goes down and you continue to own it and you wait and the stock comes back up, you never actually lost any money. The value of your stock for a certain period of time was a little bit lower, but until you've actually sold and taken cash for your asset, you haven't lost money. So if they close, they lose that money. If they put up cash in their margin account, they may end up okay, right? The stock might come down to a more normal price and it might end up that they're right in the long term, but they have to have somewhere to pull that cash from, right? So they have to sell other investments, which could cause issues in their other positions. And they might not have the liquidity to do that. They might not be able to sell the things that they have quickly enough to post their margin accounts. And this is where you're seeing big influxes of money into hedge funds. Now, why does any of this matter? Okay, why do we allow the shorting of stocks? And this is actually something I want to make sure we talk about, because a lot of people hear about shorting stocks and they are like, this is Wall Street being horrible and greedy, and shorting shouldn't exist. And why are we able to bet against companies? That seems cruel and mean and we shouldn't do it. And in some cases, that's kind of true. We are betting against companies. We are betting against parts of the economy. But what I want you to remember is that short selling is actually a healthy part of the market, because there have been many, many instances where short sellers are the ones that are out there looking for fraud in companies, looking for bad corporate governance, which means CEOs and board members that aren't properly running a company, that aren't properly disclosing things to the public. And so they short, and then they do the digging work to figure out what's wrong, and they can correct things that are wrong in the market. We wouldn't have caught Enron, all the fraud in Enron, without short sellers. They are often a leading indicator to, is something wrong here? Is the market mispriced? And so when we talk about how the market is rational over the long term, clearly by this crazy chart that we have here, right, with GameStop up to $300, this is not rational. But the market doesn't have to be rational in the moment. It has to be rational over the long term. And so stock market short selling can be a little bit of a way to indicate, right? And so Liz says this is a little bit over her head, and I totally agree. And this is something that I want to talk about it, not because I think you guys really need to know what short selling is, but I want you to know so that when you read the headlines, when your kids come to you and say, hey, I want to buy GameStop, hey, I want to join Robinhood and start trading stocks because this is getting crazy, and I think I can make a lot of money, I want you to be able to understand at least the basics of what's going on, okay? And so short selling isn't necessarily a bad thing. I'm laughing at Liz saying this is not rational. Short selling is not necessarily a bad thing, but when something gets over shorted, when you're shorting more than there is volume to buy, then you get real issues. Then you're really turning the market upside down and you're squeezing it. Now, two more things happened in this situation, right? Okay. So first of all, they shorted more stocks than were available to borrow. This is very similar to how the bank will lend out more dollars than they have in deposits, because they expect that all of the people that put money at the bank aren't going to want to get it out at the same time. And so they can actually increase liquidity and grow the economy by lending more than they have on hand. And so the Treasury Department tells them that they have to have a certain amount in reserves, so that when people want deposits, they can get them, but they can actually lend at a multiple to what they have in deposits. This happens similarly with brokerages. Sometimes they will lend more shares than they actually have available, because the stock market doesn't actually work with John and Mary going around and trading stocks, right? There's a much bigger picture here. And so there wasn't actually enough shares to close the shorts. There wasn't enough volume to close the shorts if we wanted to. That was problem number one. That pushed the stock even higher. The second thing is that you, as an owner of stocks, get to decide whether or not your stocks get lent out for shorts. And so you can't do this if you own like an index fund, but if you own individual stocks, you can call your broker and say, I don't want my stocks to be lended out for shorts. And so even fewer shares were available to cover some of these shorts because they were no longer being lended by a lot of people. And so does this sound like market manipulation? Yeah, it kind of is market manipulation. But there's plenty of people who are saying, well, I don't care. Wall Street has been screwing everybody for years, and now the little guy's going to win. Here's a problem. I am totally on board with let's get the little guy winning at some point. The thing is that GameStop is not worth $300 a share. It hasn't been worth $300 a share almost ever, right? This is not a company that has that kind of market value. And so eventually the market will settle. It will come back to a more rational number because GameStop can't prove the profits, can't prove the fundamentals to be worth this. And when that happens, there's going to be a very small door at the end of a very long hallway that some people will be able to get out before the price starts to crash. And a lot of people will lose money. And so there were people getting involved, buying GameStop at the beginning of this during this week, and they bought it at $100 and they bought it at $150. And they're still looking at their portfolio and being like, oh, I've doubled my money, I've tripled my money. But once again, you haven't earned money or lost money until you actually sell. And what happens there is, if everybody is trying to sell at once, somebody's left holding the bag. And my worry is that there are a lot of people out there who got involved without fully understanding, with thinking that there was something bigger going on, that something longer term was going on, and they are going to get stuck holding the bag. And you're going to see a lot of people who invested money they can't afford to lose money in this situation. So Roberta asked, can this work for, say, Sony or Microsoft? No, this can't work for something like Sony or Microsoft, because what caused this squeeze is massive short positions, is so many hedge funds holding very large short positions in GameStop. And that meant that people could drive up the stock and cause this short squeeze. It's not everybody buying at once that drove the price up. That happens to an extent, right? That could drive the price up to $40, $50. But what drives it from 50 to 300 to 400 is hedge funds who have a lot more capital invested than the average retail investor, having to do something very quickly, make a decision very quickly. And then their volume, their mass volume that is much bigger often than retail investing dollars, drives the big increase. And so when you talk about Sony or Microsoft, there's not big short positions on those companies. There are absolutely people who short those stocks, that those exist out there often as a hedge, but those are big, healthy companies. And so in general, you don't see something like 100%, 120% short positions on those companies, because in general, the market thinks that they're stable and they're not going anywhere. The stock's not going to crash. So GameStop has been in the market, has been in the news, the biggest, because that was the biggest change and absolutely the biggest Reddit focus. But what happened as well is that they picked other companies that were stressed and distressed that had high short positions. Actually, the Blockbuster reorganization company. So when a company goes bankrupt, they don't just cease to exist. There's often a company that kind of reemerges from the ashes, that tries to at least get as most value as possible from the assets the bankrupt company had. And so for Blockbuster, there's a company that's really just selling the real estate holdings of Blockbuster over time. It's a very tiny stock and it is heavily shorted. And so that one was another one where Redditors and people got in the social media game of starting to buy these things, starting to drive up the price. AMC was there. And all of these things. And so that's what's happening. Eventually, this will settle back down. The stock will go back to a reasonable price. And there's actually a quote from John Maynard Keynes, who is he's a famous economist, who said, the stock market can stay irrational longer than you can stay solvent. And so this is what's happening. Eventually, over the very long term, the stock market is always rational, or not, it's very close to rational. But these hedge funds, how long can they stay? How long can they hold out on these short positions? How long can they continue to cover their margin before they have to do something and take that big loss? Can this stay irrational long enough that hedge funds lose a lot of money? Absolutely. What does that mean for the broader market? It's not really clear yet. And what does that mean for how the SEC manages these things, how they decide to regulate market manipulation that looks like this, social media that looks like this? That's still unclear, right? And so we have to see what happens. But in general, this isn't an opportunity to say, oh, we're going to go make a bunch of money in GameStop. There's other market underlying things that are happening here. What can we learn from this? Okay, we've talked really fast. We've talked about a lot of different things. What do we take away from this? I think the first thing that we take away from this is that there is power in social media and in retail investors, right? Having the ability to have the communication that we have today, having the ability to see the data. Like once upon a time, we didn't know the short volume on a stock if you were an average American. You couldn't. It was something that was calculated at trading desks and it wasn't published and you didn't know. Now we have way more data, we have way more information, we can communicate. Does that mean that we will cause more volatility? My expectation is yes, we will see more volatility because we will do things like this. We will see people get angry and push push stock values way out of control or sell massively or just panic, right? When we talk about what causes volatility in the market, it comes back to that whole the call is coming from inside the house, right? It's all of us, it's all of our investors either getting really greedy or really scared and making stocks move out of proportion with what is actually going on in the economy. And so we see big booms or big busts that ultimately kind of level back out to reasonable, moderate growth. And so we might see more volatility. But this is something to remember too, that you don't just follow stock advice that you follow online, that you don't pay attention to headlines. I think if you download our free Money Mama's Guide to Investing, which is linked above this video or below this video if you're on YouTube, it's actually smartmoneymamas.com/invest. We talk through what investing is, how it works, and then how to really do more long-term buy and hold index fund investing, which is cheaper. And what's one of the best things about long-term index fund investing is that you get to kind of just ignore. You just kind of get to set aside all the headlines. You set your goal to I'm investing until retirement. I'm investing for 20 years. And the ups and downs in the market, I'm going to stay consistent regardless of what happens. Okay. That's just an easier way to do it. So don't follow people who are online. This is also an example of what happens with short selling. I think that shorts are something that they occasionally come up in headlines. They occasionally come up in the market and we don't understand how they work and we don't understand how they can cause issues. Short squeezes and whatever, happen. And so I want you to know what that is. And so when you see those words, you know what's happening. Yes. Are people betting that stocks are going to go down? Absolutely. But often it's just part of a broader investment position. It's not saying like, hey, we hate GameStop so much as like, hey, we want all retailers to fail. It's more saying I'm going to buy Steam, which is an online seller of games, and I'm going to sell GameStop because I think the long-term trajectory is that we buy more online and buy less in stores. And so I'm taking both sides of that position. I'm short GameStop and I'm long. I've bought Steam, right? Something like that is more what you're typically trying to do is take a position on a market trend more than you're saying like, I hope that GameStop goes bankrupt. That's not usually what's happening. And then consistency, right? And this is the third thing is just finding your system and sticking to it regardless of what's happening in the media. I know we've already said this, but headlines get us really caught up and they're really they get us caught up a lot for kids as well. We see a lot of teenagers, especially if they are on places like Reddit, if they're on places like TikTok, especially money talk has become this big thing where people who do not have a lot of expertise are sharing money advice, sharing investing advice, Bitcoin, and cryptocurrency investing, which we talked about on the mailbag episode of the Smart Money Mama Show, our podcast on Monday. They're sharing things that are very complicated and very risky, and your kids might be getting involved in that. And so if you have, 15, 16, 17-year-olds who are coming to you asking to invest, first of all, remember that they have to have custodial accounts. They should not be doing this on their own. They legally can't be doing this on their own. And if you have kids that are 18 to 25, our kids think that they know more than they do at these ages, right? And so make sure you're having good conversations with them. Make sure you're sending them videos like this one, good books about investing, good books about money management, so that they don't get put in a position where they're really getting scammed out of a good amount of money. Now, we have a few questions here, but the first one I want to address is something that's been asked in a few different places as we made this video, which is, should I open an account with Robinhood? We've had a few people in our community, friends reached out to them and say like, hey, Robinhood's running a thing right now where if you you open a Robinhood account with my link, you get a free stock and I get a free stock. Like, let's open a Robinhood account. First of all, Robinhood always does that. That's not a recent promotion. That's just their method. Robinhood once upon a time. So if you used to want to buy a stock, let's say you wanted to go buy 10 shares of GameStop, you had to pay what was called a broker fee. And that could be anywhere from a few bucks to 20, 30, 40 bucks, depending on the size of the offer and who you were using as a brokerage. You guys probably remember the old advertisements from like E-Trade that was like $7.95 a trade, $7.95 a trade. And that used to be a really good deal. Okay. But now, Robinhood several years ago came out and they were a no fee brokerage. So you could go in and buy stocks and bonds and ETFs. And now they've even added things like cryptocurrency for no trading fee. And their whole goal was to democratize investing, to make it easier for anybody to invest who wanted to invest. And it sounded like a really good model. And in a lot of ways, their app has great functionality and they're a company that's trying. But I think that what's happened is they've gotten bigger than they expected, and there's things that they're doing that just aren't great. And so right now, with GameStop going crazy, with AMC going crazy, Robinhood actually went in this morning and did what they call delisted certain stocks off their platform. So you can't go in there right now and buy GameStop. You can't go in there right now and buy AMC. You can only sell. And that is not free market, right? That is not allowing trading that needs to happen. Can the SEC come out and say we're putting a break, what they call a break on a stock, and say we're not going to let it trade for an hour, we're not going to let it trade for a day while this cools off? They can absolutely do that. But a broker doing that is a totally different situation. And it really is their own version of market manipulation. Are they trying to cover their own asses because they're worried that they're going to get in trouble for all the Redditor people that were using Robinhood? Maybe, but there are things like that happen. And there's also a situation. Roberta, I do see your question. I'm going to answer it in 1 second. I lost my train of thought. There've been a lot of situations where things like this have happened, where the market is going up a lot or the market is going down a lot, places when people want to make a lot of trades and all of a sudden Robinhood is down or it doesn't work, or they have a tech glitch and people have seen massively negative accounts when that wasn't actually the case, and it pushes people into do dangerous activities. They had an instance last year where a boy actually committed suicide because he thought his margin account was massively negative. And so these are the things that, and it wasn't actually even true. It was just a glitch, and it's just horrible things like this that have happened. And while Robinhood had a good model in the free trades, what happened is there's big brokers that have a lot of money, a lot of power, and a lot of experience in doing this securely, who saw what Robinhood was doing, saw the interest for people and said, fine, we'll do free stock trading. So you can do free stock trading at Fidelity and at other places that are much more secure, that don't have these issues of like suddenly deciding to turn off trading and things like that. And so I would go with a more traditional broker. You could open an account at Fidelity with no minimums. You could go to Charles Schwab. I think their minimums are like $1,000 or something. You can go to other places and not have to use Robinhood, especially because I wouldn't recommend single stock investing for almost any of you. If you go read the Money Mama's Guide to Investing, we have some more explanation about why that is. But most of the time you can't win picking stocks anyway, so you're better off doing index funds. You'll make more over the long term. All right. And so those are the main things we're going to talk about. But let's see, we have some questions here. Roberta says, will anyone who owns the GameStop stock today, who purchased at $4 a share and sells at today's price, come out on top? Yeah. I mean, so if you owned this thing from last year at $4 a share and you had the opportunity to sell it now at $2.97 or whatever the price is currently, you would make a ton of money, right? So if you had $100 in this, you're now going to have $29,000 or whatever. You're going to massively, massively increase your money. The thing is that we can't, anytime a trade happens, there needs to be a matchup. Somebody has to be willing to buy when you want to sell. And so what happens when the market is up like this is that and this is what I was saying about a small door at the end of a very long hallway filled with people, and this crunch that's going to happen. Everybody's going to start to want to sell. At some point, this game will end. There's a hashtag going around, hashtag to the moon, where, the Redditors and these people that are involved in this activity want to drive the price to the moon. But at some point, people get nervous and they get greedy, and they know that GameStop's not worth $300 a share. And so they start wanting to sell. And when that happens, they have to find somebody who's still willing to buy it. And there's very few people who want to buy it at $300 a share because it's not worth $300 a share. These are the people that I'm most worried about, the people who are like, I want to go buy GameStop because I just saw this headline about it being up 7,000%, but not understanding. And so they go buy it at $300 a share and then it falls, right? And so what happens is, let's say we've got 1,000 people who want to sell at 300 and only one person who wants to buy. Well, now that person has all the negotiating power. They can be like, well, what if I bought it from you at $150? And then maybe everybody walks away and they don't get to sell at $150. But it's this pricing that it's ultimately going to come down because you have to have people who are ready to buy. So there will be some people who are, and somebody said it's down to 155 at the moment, right? And this is what I was saying about changing this chart a bunch of times this morning before we came live, because At one point, I had $425 on this chart, and you're going to see that crash happen. So yeah, Jessica, exactly. This is going to happen. If you can sell, if you can actually make that transaction happen, you might make a lot of money. And there will be a few people who make a lot of money from this game, this thing that happened. But a lot of people won't, and a lot of people will lose a lot of money as well. And not just the hedge funds. There will be retail investors who lose a lot of money about this. And for some of them, there are people that their whole goal was to stick it to Wall Street, and that this is money that they were willing to lose, and they understood what they were going into. But there's also going to be a lot of people who just got involved without really understanding, and they're going to lose money. And that's what makes me really nervous. Sonia says, Chelsea, would now be a good time to take my Roth IRA and move it to something like Ellevest or Robinhood? If so, where would be the best place to look for that? Okay, so no. First of all, Robinhood can't do retirement accounts in the first place, and I wouldn't recommend you do them there anyway. It depends on where your Roth IRA is, Sonia, and what you're trying to achieve. If you're trying to get more of a robo-advisor experience, which is what you would get at an Ellevest or a Betterment or an M1 Finance, which is somebody else manages your investment for you, like basically an algorithm decides what stocks and bonds you're going to own of index funds. They're not going to pick individual things like GameStop. But there's no real timing of how to do that properly. There's no timing of how to do that properly. It's more just like, what are you trying to achieve? What are your fees? And can you roll what you currently own in your Roth IRA over to similar funds at a different brokerage? It really would depend on what you're trying to do, Sonia. Cecile says, if I sell all that I have with Robinhood, I don't have GameStop, LOL. Is there fees, charges that I need to pay? Example, I put in $200 of my own money. Now I see that it's up to $250. Please help. Thank you. Okay, so this is going to depend on what you want to do. So if you own a few shares of different companies and you want to just move them to another brokerage, you want to move them to Fidelity, you would set up an account with Fidelity, and then you would ask them for a form to move you from Robinhood to Fidelity. There's no fees for that from Fidelity. There shouldn't be fees from that from Robinhood. And if you own individual shares, Fidelity can just take over ownership. They just transfer ownership over to their accounts, and you don't pay any taxes or anything like that. If you want to sell, if you actually want to sell what you own in Robinhood, take it in cash and invest it back at another company, you're going to own capital gains. And so what we talk about is, we're going to use the whiteboard again. You invested 200. I need a bigger marker. You guys are going to complain that you can't see because, of course, you can't. It's a tiny marker. Okay. You invested $200. It grew to $250. All right. When you sell, you don't owe taxes on the whole $250. You owe taxes only on the growth. Okay. So you owe what's called capital gains taxes on this $50 that you earned. And wow, that is a horrible 50, but you guys are following me. If you owned your position for less than a year, that $50 is taxed at your income rate. If you owned it for more than a year, you pay what's called long-term capital gains, which is a lower rate. That could be anywhere from like 0 to 15%, but you will owe some taxes here. That's why if you want to continue to own the shares, if you like the companies that you own, I would just transfer them over to another brokerage with Fidelity. Don't sell them to cash. Just fill out the form to transfer it to Fidelity. If you want to owe, it's $50. You're going to owe $10, $15 in long-term in capital gains. I wouldn't worry about it, but there won't be fees for the process. It's just what taxes. You got to worry about taxes. Janice says she's loving the whiteboard. Sonia says, I have Ellevest, but I want more involvement than what I'm currently getting over there. Yeah, and so you could, if you want to be more involved, you could move your money from Ellevest to Vanguard or to Fidelity. Those are the two places that I would recommend. And then I know, Sonia, you have access to the Money Mama's Guide to Investing and the things like that. You can set up your own 3-fund portfolio. You could buy a target date retirement fund. You could do what you wanted. If you want more help than you're getting at Ellevest, that's a different situation. If you want more help, really only the next option after a robo-advisor is to hire a financial advisor. Just make sure you find somebody who has fiduciary responsibility, ideally who has a CFP. You can find good advisors on XY Planning Network. All right. Let's see what other questions we have. We had a question about Tesla. Somebody said, what about Tesla? Okay. Cindy said, what about Tesla? Tesla is a different situation than GameStop. So Tesla is up a ton this year, out of control, up a lot of money. What's happening there is that Tesla actually posted their first full profit year ever. Just yesterday or the day before, and they are growing and they are making cars more affordably, and there's a long amount of people there. There's a lot of people out there who think that Tesla is the future, right? Electric cars, nice electric cars, that have long running times, that have, that work well, that drive well, are going to be the future. And that what we see from Tesla right now, it's going to be an explosion, right? They're going to ultimately figure out how to make these cars even cheaper, and they're going to become more of a mass car producer than a luxury small volume car producer that they are now. And so those are people betting on the actual long-term value of the company. Could they be wrong? Absolutely. Like, that could totally happen. Or they could be right, but not completely right. Like, Tesla could become a much bigger car producer, but not enough to make the stock price worth it. And so you'll come back to somewhere more in the middle. But that's not any kind of market manipulation. That's just people truly thinking Tesla is going to be a good investment opportunity, is mostly what's happening there. Roberta says, is the Smart Money Mama's Guide to Investing, are there books out there we can read to understand investing, or any you can mention now? I don't think we have book recommendations in that guide, though that guide is like a 20-page, like pretty detailed explanation of what to do. But some recommendations that I would make to you are, first, Broke Millennial's Guide to Investing is excellent. It's written by Erin Lowry, and she did a really good job breaking down all the basics, all the things to consider in an understandable fashion. That's a great one. If you want to talk about investment theory in general and really a simple way to invest on your own, I would read J.L. Collins' A Simple Path to Wealth. It's a really good choice. Or Vicki Robin, Your Money or Your Life. There's also the book Invested by Daniel Town that is very good. Those are some good choices as well. And then Michelle says, Tesla also makes the best home backup power batteries. Yes. And so there's things like that people think that we're going to see more solar panel installation because Tesla merged their solar panel company into Tesla a couple of years ago. So they think that Tesla's going to see solar panel growth. Tesla's going to see home batteries that get sold with solar, so that not only can you have power from your home when the sun is out, but you can store power from your solar panels and actually make your house more self-sustaining. There's a lot of different stories that go with Tesla about why you're going to see long-term growth that aren't really market manipulation. But does anyone else have any other questions? I'm going to take a drink of my drink here. What I want everyone to take out of this is that the market can be irrational in the short term. We can see massive declines in stock prices overnight. We saw it in the Great Recession, right? We see it in major downturns. We can see major growth overnight. And that does not mean that that is what to expect from the market on a regular basis. Over the long term, results smooth out. We see growth more in that 7 to 8%, 7, 8, 9% range as a market as a whole. And so if you can pick a consistent investing strategy where you buy and hold long term and you kind of ignore the market headlines, all of these things, that is the best case scenario. Also, remember, when you see these headlines, talk to your kids, especially when they're social media related, especially when they seem to be things that are, interesting for kids, game shops, movie theaters, entertainment, things like that. Make sure you're having conversations so that they don't fall for fraud. I hope this was helpful. If you have follow-up questions, continue to post. We will be watching and providing information. And I'm interested to see how the end of this GameStop ride goes, and hoping that the people that are going to end up losing money on it have the money to afford to lose, and that this situation works itself out as best as possible for everyone. Like I said, if you want to download the Money Mama's Guide to Investing, it is linked above this video, below if you're on YouTube, or it's smartmoneymamas.com/investing. Thank you all so much, and I'll talk to you soon.